back. You're watching Your World at 10. Now, as we've been telling you, the government has released the second discussion paper pertaining to the Direct Taxes Code. It was released this evening, and joining us to discuss the new proposals in this second discussion paper, and they span 11 topics of interest. I'm joined by Ketan Dalal, the Joint Head of Tax and Regulatory Services at PwC, Dinesh Kanabar, Deputy CEO and Chairman Tax at KPMG, and also joining us, BSE Member Ramesh Damani, to help us understand how the markets will react to the changes in capital gains taxation. I'm going to come to the broad and the big issue here, which is of capital gains. And the reason I'm not going to MAT first, Mr. Dalal, is because they have said that they propose to compute MAT with reference to book profit, which is exactly how life is today. Right. So there is really, in that sense, no change for corporate India with reference to MAT. The big change is in capital gains. And while the earlier code proposed to take away any distinction between long-term and short-term capital gains and club all capital gains to be taxed as per your slab rate, in this code they have made or created a certain advantage for long-term holdings. But I'll just go through them with you one by one. They have said long-term is only long-term if it is held for a period of more than 1 year from the end of the financial year. And that means it's no longer 12 months or 365 days. It could in effect be even two years if you end up buying securities on, let's say, April 3rd, and that's the beginning of a new fiscal year. You have to wait till your fiscal year gets over, calculate another whole fiscal year, and then be able to avail of long-term benefits. Am I correct?
Absolutely right. And to that extent, the beneficial impact of a long-term capital gains has been diluted because you're changing the very definition of long-term capital gain. As you said, it could be 23 months and 29 days, for example. So to that extent, you're absolutely right. And of course, the benefit itself has, to that extent, also been reduced because there is an exemption if you sell on the stock exchange. That has been replaced by a different regime.
Absolutely. So what they've suggested is that of the total quantum of long-term capital gains, there will be a deduction rate, the rate which has not been specified as of now. That amount will be deducted and the rest of the capital gains will be taxed at your slab rate. As far as short-term capital gains goes, all of it will be taxed at slab rate. And the other important development for the markets is that all income arising on the purchase and sale of securities by an FII will now be income chargeable under the head of capital gains, and they will be subject to advanced tax. And finally, they've said STT is proposed to be calibrated based on the revised taxation regime for capital gains. Net, are we better off with these suggestions on the capital gains regime, or do you prefer what we have today, which is the current situation, or what the first code put in?
Look, it depends on what you are. So if you are, for example, an FII, today most of the FIIs are coming in through the Mauritius route. And Mauritius, as you know, the capital gains tax has been exempt. It does not talk specifically of business income, but business income, if I put it in technical terms, would be chargeable to tax if you have a permanent establishment. And because of the capital gain exemption, FIIs coming through Mauritius claim the capital gain exemption. Right. Now they've said that it will be subject to, it will be characterized as capital gains. To that extent, there is clarity, Menka. The point, however, is that while there is a treaty override neutralization in the new discussion paper, it is subject to a carve-out of few things, but the one which is relevant is a carve-out for general anti-avoidance rules. And in simple words, what it means is that you're entitled to the benefit of the treaty. However, if you are resorting to what the government considers as anti-avoidance, then you will not be entitled to the benefit of the treaty. What I'm fearing is that the general anti-avoidance carve-out can be used to attack the benefit of the India-Mauritius Treaty, which might be the intention anyway. So if you are an FII, to that extent, you will probably wind up paying tax at the normal rate. And if you are long-term...
What is the normal rate, if I may ask you?
The normal rate was supposed to be 25%.
As proposed in the earlier code, right?
Yes, there is a hint here that it may need to be recalibrated. So let's assume that it is 30%.
Okay.
And if it is over 1 year,
right,
then there will be some deduction. So let's say the deduction is 50%. So you could wind up paying capital gains tax at, say, 15% if you held it for more than 1 year, and as you rightly said, more than 1 year could be end of the financial year, so to that extent. So you could wind up paying something between 9 and 15% if one goes by their example, as opposed to 0, which you're paying now, if the Mauritius Treaty benefit is not available.
All right, but that is as far as FIIs go. If I am a long-term retail investor with the person who buys shares with the intent of holding on to them as an instrument of savings, so to speak, then really this is a regime that is more beneficial to me because it allows me to hold shares for a longer period and avail of a minor benefit for holding those shares over a long period. So I don't have to, the earnings from those shares, I don't have to in some sense tax them at my income tax rate, right? Because at the end of this, it will be taxed at a deduction, post-deduction.
Menka, you're right if you're comparing it with the first draft of the direct tax code.
Yes, of course.
However, if you compare it with the position as it exists today, that you're completely exempt from capital gains tax if you sell shares on the stock exchange, then that is not so. But yes, compared to what the position was in the draft direct tax code and this discussion paper, I mean, clearly this discussion
So we're
paper
a little worse off from today, a little better off from what the direct tax code or draft tax code had proposed at that time.
I would not say you're a little better off compared, you're probably much better off than that, but you're much worse off than today. It's somewhere in between.
All right. Mr. Kanabar, a quick comment from you on what this new proposed capital gains tax regime will mean for both retail investors, traders, as well as FIIs.
I guess, first, let me just put a different proposition here, that there was really an issue that if you held shares in a company, then those shares were regarded as one of those assets on which you had to pay wealth tax. You now have a situation where wealth tax is payable only on non-productive assets, and therefore to that extent holding of shares as an asset class probably is better off than what it was under the original code. Second is that this hint that the rate of tax could be 30%, as is borne out by the illustration, is a bit of a worry, because you were given an indicative rate of 25% in the direct taxes code. We all know that was only an indicative rate. Really, the rates had to come out year to year, but the expectation was that the rate would not be more than 25%, and now an illustration shows that it could be as much as 30%. But given overall the fact that we are moving towards a common rate of tax, not a multiple tax rate regime, which indeed is really the thrust of the direct taxes code. Simplicity, you just have one rate of tax, and that applies whether it's capital gains, whether it's business income, whether it's anything else. The proposition that you would now move to taxability of capital gains was given. The question was, would it be taxed fully, or would you get some sort of an exemption if it was long term? And I'm really glad that the government has gone back and reflected very hard on the proposal which was put, that the doing away of the distinction between a capital gain and a normal income should be preserved, and doing away was not warranted. And to that extent, if 50, 60 or 70% of your gains are tax exempt, then you are indeed paying a rate of tax which you were earlier not paying, but you are still in a significantly good position.
Ramesh, this is definitely a more palatable proposal than what the direct tax code last year released proposed at that time, though it may be a little, put investors a little worse off than where we are today, considering that today there is no long-term capital gains whatsoever and short-term is at 15%.
Yeah, you're right. But Menika, it's in fairness of things. I think as long as the capital gains rate is stable and is well defined, there's a lot of litigation going on between what constitute capital gains and trading income for the last 5 years. So there was not even certainty about that. So as long as the government gives us a reasonable reduction, say 50%, and the long-term capital gains is 12.5%, I think the market will be able to absorb it. Going from 0 to 25% would create huge distortions in the market. But the market probably opened with a lot of uncertainty tomorrow. So my sense is uncertainty will cause prices to be a bit soft tomorrow morning.
Mr. Kanabar, how do you expect FIIs to react? Because, like Ramesh pointed out, this puts an end, to some extent, to the litigation between whether this constitutes capital gains or business income, etc., etc. But it also means now that they will have to pay a capital gains tax. So how do you expect them to react, or will they just be relieved, as Ramesh put it, that there is some stability, or could there be a negative reaction?
One thing which we tend to forget is, we are comparing a proposed rate of regime with an existing regime. And when the direct taxes code was tabled, I think the government came up with a proposition that stop comparing this code with what currently exists, because we are moving to a new regime. And that new regime has got several things which are pluses and minuses. And to answer your question specifically, Menka, I would like to believe that FII should really welcome this step. They indeed are moving to a tax regime. However, the tax regime is a palatable tax regime. If you are looking at a rate of tax of between 9 and 15%, indeed it is infinitely more than what it is today. But certainly it provides a handle that you now don't have the issue of whether it's business income, whether it's permanent establishment. You're moving towards a certainty, and I think that's something which people would very much welcome.
Mr. Dalal, can that be challenged? Can FII say, but how can you deem what we consider business income as, income that's chargeable to capital gains?
I'm not sure, Minka, that can be challenged, because...
I mean, that is if this becomes law, right? This is still only a discussion paper.
But so on the assumption that this becomes law, I don't think that can be challenged, because characterization is something that has to emerge from a legislation, and that's what they've done. But I just want to make one more point.
Sure.
The rate between 9 and 15, palatable or not palatable, is one issue. But currently the computation of capital gains is computed in foreign exchange terms.
Right.
And to that extent, if the rupee depreciates against the dollar, then the FIA does not, at least assuming that it does not use Mauritius, does not wind up paying capital gains on the rupee income.
Okay.
It winds up paying only on the foreign exchange income, which could be lower. That is not clear yet, and to that extent, if the rupee depreciates on an ongoing basis, it's not been currently. It's not for at least against all the currencies, but going forward, that is something that would have implications.
So we need to wait for the fine print on that as well, which I suspect will be in the sort of the draft that is presented to Parliament. The last point on this is they've said, accordingly, STT, which is Securities Transaction Tax, which in the Direct Tax Code draft, which was released last year, was to be done away with. Here they've said STT is proposed to be calibrated based on the revised taxation regime for capital gains and flow of funds to the capital market. Does that mean we can expect a reduction in STT because now they've taken away some long-term benefits?
I would think so, and I think as Dinesh was mentioning, I think from a tax perspective and an STT perspective, my sense is there may be a rollback, but there may not be a complete doing away with it, because I think
so a reduction of some sense to the rate.
Yes, absolutely.
That's definitely good news. The market should actually be able to accept that with a great amount of welcome, because that's something that every single trader in the market, including investors, paid, right?
They did, but it was a very efficient tax collection mechanism.
That's true.
It was charged at source, the revenue boom, and the arbitrages who were struggling doing their business because of the SCT will be the big gainers. But I'd like to ask a question of your expert panel, Menika. Is dividends considered tax-free yet, or are they going to be taxed as normal income?
Mr. Dalal?
Currently, there is no move to tax dividend. I think the same thing continues, except that dividends derived by companies from foreign subsidiaries, and I know that is not Ramesh's
the
question.
Controlled for, CFC.
That's a different, so that will be taxed,
right?
Whether declared or not.
But that's more for corporates and less for investors, so to speak.
Correct. So I know that Ramesh's question is more from the perspective of dividend distribution. That continues in the foreign.
So that is still continues to be borne by the company and not by the shareholder or the investors.
That's correct. At least there is no indication to the contrary in this.
All right. The one other really important issue, or the two other really important issues which to some extent were interconnected, was the imposition of a GAAR, which is the General Anti-Avoidance Rule, as well as the overriding of all double tax avoidance treaties. Mr. Kanabar, both those measures have been diluted. And in fact, the good thing in the GAAR is they've said that the Central Board of Direct Taxes will issue guidelines to provide for circumstances under which GAAR can be invoked. It will only be invoked in respect of an arrangement where tax avoidance is beyond a specified threshold limit. So it will not be invoked in very small cases, and it will be accompanied with the ability of the taxpayer to go to the dispute resolution panel. This is very encouraging because to some extent the big sort of evil Ravan that all of you were making GAAR out to be looks a lot meeker now, doesn't it?
Two things. First, I think there is a substantial dilution, and that dilution is at two levels, Menka, not just the level which you are mentioning.
Sure.
So, in the current code, the provision was that any mitigation of tax liability would be presumed to be a transaction which is tax avoidance. That now goes away, and there are 4 circumstances which are prescribed which ought to exist for a reduction in rate of tax to be regarded as anti-avoidance. So that includes things like transactions not being as arm's length or an abuse of a provision. And I know that, we as tax consultants tend to rush and say that the word abuse will be interpreted by tax office in a very negative manner, etc. But shown of all of those, I'm sure there'll be enough safeguards around that. So there are 4 circumstances which ought to exist before which a general anti-avoidance regulation can be invoked.
Last word to you, Mr. Dalal. I think they've managed to be able to dilute both GAAR and DTA to now, or treaty override, to acceptable levels, whereby you're protecting the taxability of certain income, but you're not going overboard, and that seems totally fair. No?
I would tend to disagree.
Okay.
Insofar as treaty override is concerned, Menka, I do agree that the treaty override in any case, honestly, was something which could not have been done unilaterally in the first place. So in a sense, they have rolled back to a position that could not have been achieved anyway. And you cannot amend a bilateral treaty by a unilateral act. So that's fine. And that's a good thing. Even an attempt has not been made to do that now. So that's fine. However, in relation to the GAAR, I would tend to disagree with the comments earlier made for a variety of reasons. The first issue is that the GAAR can currently be invoked by a commissioner of income tax, and I understand that guidelines will be issued. But if one person, without possibly a time limit, can invoke GAAR at any point of time, and I hope that the CBDT guidelines take all this into consideration, that can be very dangerous. Secondly, one must distinguish between GAAR and the way it is used in a developing country and the experience there has been, and this is in US, South Africa, etc. The experience has been that GAAR has been used in very, very limited cases. Here the concern is that GAAR can be used in a very sweeping manner, and given the fact that litigation can go on for a long time, that's a problem.
Maybe being concerned too early, considering that they have so willingly diluted the entire concept that they first laid out last year. And not only that, they've given you access to a dispute resolution panel if you disagree with the invocation of GAAR. So to some extent, they have created an option for you to be able to appeal that.
Menka, and that was my last point. The dispute resolution panel, in the way that it has been framed, consists of the composition is administrative commissioners as opposed to appellate commissioners. By itself, therefore, the composition of the commissioners being administrative, and I don't blame them, because if they are administrative commissioners, they are bound to take a pro-revenue, and which is what is happening today on the ground. Therefore, if the composition of the dispute resolution panel remains the way it is, then I am afraid that going to the dispute resolution panel will not resolve your dispute. It will probably be confirmed, and you will go and wind up in appeal.
All right, we'll test that when it actually does become legislation. Last word from you, Ramesh. Considering that MAT is now back to with reference to book profits, the SEZ exemption states for the period that it has currently been given out to SEZs but will no longer be rolled over. They have substantially widened the EEE scope, and they've minorly tinkered with capital gains, but yet giving you a benefit for long-term holdings. This should be a lot more palatable to the sort of the markets than what the earlier proposed code was.
It will be, but it will create uncertainty. What will be the tax deduction rate? What is the wealth tax provisions? Uncertainty means the market will open probably weak. The good news, Meneka, is the Indian economy is booming and will recover from this setback. I have no doubt about that. I think the underlying tone of the economy and the market is extremely buoyant right now.
All right, gentlemen, we'll leave it there. Though one question remains to be answered, and that is if the government can at all stick to the proposed reduction in corporate tax rates to 25%, as suggested last year, considering that this code may now not be revenue neutral and they may not have the ability or the comfort level to bring taxes down to 25%. But that's a